Now let's try to see accounts payable turnover ratio. So basically accounts payable turnover ratio simply tells you that how much time it takes for you to pay your payables, right? So basically whatever goods you purchase, you needs to sell them, right? So whatever you purchase, you need to pay it to your creditors for that as well. So the formula for that becomes cost of goods sold, whatever goods are there, divided by average accounts payable, whatever average payables you have in your financials. Now let's go above and see what does this mean. So in our PNL, if we go and see, this is our PNL, and within that the cost of goods sold is $250 here. And if we go above in our balance sheet, in our current liabilities, in our accounts payable section, we can say $60 is accounts payable for the current year and $50 for the previous year. So our average accounts payable for the period would be 60 plus 50 divided by 2. That will give us total of 55 average accounts payable. Now if we go to our accounts payable here as well again, so one second. Yeah, so here our cost of goods sold was, as you can see, it is 250, and our average accounts payable was 60 plus 50 divided by 2. That gives us 55. And if we solve this equation, we got the accounts payable turnover of 4.5 times. Now accounts payable turnover simply means that how efficiently we are paying to our accounts payable. Now let's see how the companies use them and what are the implications of that. So it shows how quickly a company pays its supplier. If this ratio is higher, company pays very quickly. It's like if you are having your business and it's like it's let's suppose 12 times, it means that you are paying your creditors or accounts payable 12 times in a year. So that is a good thing for the creditors, but it may not be good thing for you because you are paying them very frequently. If this accounts payable turnover ratio is only one time, which means you are paying your creditor only one time in a year, so this may be very good for your business because you are deferring their payment, but it may not be good for the suppliers. So if the ratio is higher, company pays very quickly. So when the company is paying quickly, the suppliers have good relationship with them, but the company has lower cash because they quickly pays to the supplier. And if this ratio is low, then company is basically delaying the payments, and it means company is having more cash available with them, but it may strain the supplier trust and relationship. And in future, if you go for negotiation, you won't be getting the negotiation benefits from the suppliers. The next is like supplier watches this ratio to judge if the company is reliable, because if the company is not paying very frequently, it's a riskier thing for the supplier. And consistently low accounts payable ratio mean that the company is struggling with the liquidity, because if the company is not paying its creditor, then it simply means there are problems of liquidity with the company. Next benefit is the working capital strategy, and it helps the management to have a balance between paying suppliers and maintaining the cash for operations. And you can do the comparison with industry peers as well. Now, if we see the real world examples, so there's a case of Walmart. Now, Walmart does a very great negotiation for long term payments with suppliers, because Walmart does a efficient negotiation. Why they do it? Because they say that instead of paying you after 1 year, we'll be paying you after 10 days, 15 days, 30 days. So if they are paying so quickly, then the supplier also gives them higher discounts. This reduces the payable turnover ratio and allowing Walmart to hold on to cash longer time and funds its operation. Also, there may be situation that instead of early payment, they may defer the payment to their vendors or suppliers as well. When they defer the payment to their vendors or supplier, then the Walmart may have higher cash. So it all depends. It's not a static thing that Walmart will have lower, I can say, lower accounts payable ratio, turnover ratio. It may have lower or higher depending upon different kinds of supplier. But for our example purpose, we are simply saying that they generally pay delayed to their suppliers. Why delayed payment? Because they have very strong negotiation power. If we see Apple, so Apple has a strong supplier relationship and high bargaining power. Right? Why they have high bargaining power? It negotiates favorable terms but also pays on time to maintain the reliability and balance in this ratio. And there are some smaller businesses as well wherein higher payable turnover ratio is there because they cannot negotiate, because generally if the people are in the position that they cannot negotiate, so the payable ratio becomes higher, which means long term payment terms with the suppliers and need to pay quickly. So it all depends upon different businesses, but at the end the simple summary is like this: if this turnover ratio is higher, meaning you are paying very quickly to the suppliers; if this is lower, you are paying very slowly to the suppliers.